Good afternoon. How's everybody doing out there? Jeremiah Conjure here from Annuity Association, here for another independent, unbiased annuity review. Today we're going to be discussing the Protective Life Guaranteed Income Indexed Annuity. Now, this is a little bit of a different type of annuity in the sense that this is a indexed annuity. However, it's solely designed for guaranteed lifetime income. And that's where it really competes. That's where it really shines. And today we're going to be discussing the ins and outs, the features and benefits of the Protective Life Guaranteed Income Annuity, as well as taking a deeper look at the payout rates for lifetime income and seeing how that stacks up against the rest of the competition in the marketplace as it sits today. So definitely excited to cover this annuity. This has been a top 10 selling annuity in the fixed indexed annuity space for 2020. And from an income perspective, it's definitely one of the most competitive. It actually, depending on certain age and payout factors, it actually competes with single premium immediate annuities, but you get the benefit of the indexing so that, you're not annuitizing your principal. You're actually able to still maintain some control on your initial investment or single premium. So bear with me one second. I'm going to go ahead and share my screen and we will get started. As always, we're going to start with our handy dandy disclaimer. So today, Protective Life Guaranteed Income Annuity. This is an independent review by annuityassociation.com. This is a review, not a recommendation to buy or sell an annuity. Protective has not endorsed this review in any way, nor do we receive any compensation for this review. This review is meant to be an independent review at the request of website visitors so they can see our perspective when breaking down the positives and negatives of this particular annuity. Before purchasing any investment product, be sure to do your own due diligence and consult a properly licensed professional should you have any specific questions as they relate to your individual circumstances. All names, marks, and materials used for this review are property of their respective owners and not that of annuityassociation.com. While care has been made to ensure this review is complete and accurate, no guarantees are made to the completeness or accuracy. So we've got that fun stuff out of the way. I do appreciate you bearing with me while we read through that. Really the sole purpose of us conducting these reviews is to really bring a level of transparency to the annuity buying process for you as a consumer. There's many different annuities out there on the marketplace, thousands, if not more than that. And, when it comes down to understanding annuities, that's the first, part in making an educated decision is learning about what you're buying. And we're really trying to change the way annuities are bought and sold because there's so many different intricacies that can impact the decision, and many times those details are not brought to light enough to help the customer or client make an educated decision on which one's best for them. In addition, because of there being so many annuities on the marketplace and so many different insurance companies, most advisors and agents are not equipped with the tools or time, for that matter, to understand all of the different products available on the market today and the features and benefits of each. So what ends up happening is, these advisors and agents, and I'm not putting them down by any means because, I know that this behavior is not intentional. It's just the industry as a whole is very archaic. So, having enough tools and softwares to be able to put all of the annuities into one place is not a commonality today. So that's kind of where we come in as an organization, is we can take clients through a very educational process. And once we decide which type of annuity is right for them, whether it be an income strategy or a growth strategy or a combination of the two, we then can take you to the independent marketplace to look at every single annuity available to determine which one's going to be best for your unique circumstances. And that's the purpose of these reviews, is to help you make an educated decision on the different ones that are available. So here is the brochure from Protective. So with this being an income-focused annuity, so keyword here is income. We're going to be talking a lot about income today. When people are looking at this annuity, the sole intended purpose should be guaranteed lifetime income. Now that can be either single life or joint life, where income covers you and your spouse or you and a loved one. But when looking at the protective life guaranteed income indexed annuity, the goal here is income first. That should be our priority if you're looking at this annuity. So, understanding the need for guaranteed income, they throw out some pretty alarming stats here, but 53% of retirements are earlier than planned and often not by choice. And that's obviously been a valid concern this year with the coronavirus pandemic of 2020. Several clients that we've worked with this year have been either laid off or they just, either furloughed or laid off permanently. And because of the fact that they have to take income earlier than expected, an income annuity is based on that primary need, needing income immediately. That's what annuity is built for. And, it's definitely something that you need to take care of. And unfortunately, those types of events can happen more often than not, especially as we get older in our working years. If we get laid off, it's harder for us to find a job or find one that's equivalent to what we were making or maybe the benefits that were offered. So if you find yourself in that position, we're here to help you identify the right income annuity to help supplement your Social Security so that we can get you taken care of from a retirement income perspective. So one of the other stats they throw out here is approximately $248,000 has been the average income gap that could result from 5 unplanned years in retirement. So there's a big difference in retiring at age 65 to age 70. So if you were planning on working to 70, or maybe it was 67, which is most people's full retirement age for Social Security, if you were born after 1960, retiring at 62 instead of 67, there's a big difference there, especially when you factor in the Social Security income that if you elect to turn it on at 62 versus your full retirement age, you're losing a significant amount of income there. And then in addition, because you're no longer working and having earned income, filling that gap, that 5 years of earned income that's now gone out of the equation or out of the picture, you have less savings to work with. So an income annuity is designed to efficiently create guaranteed lifetime income streams, and it's actually proven to, more efficiently create an income stream versus the standard traditional retirement approach where you rely on market returns from the stock market. So in addition to that, rising healthcare costs are something else that retirees are concerned about. It's very understandable. Medical expenses could be greater than we all think. $600,000 is the figure they're throwing here in the brochure for lifetime healthcare cost for a 65-year-old couple. And because of that, $300,000 is the gap that you could be left with, even if Medicare covered half of that. So even if Medicare covers that half of that $600,000 lifetime healthcare expense in retirement, you still have $300,000 that we need to plan for. And an income annuity can be, if strategically designed as part of your overall retirement plan, it can help you fill that income gap. They also threw out some stats regarding market volatility. So people that buy indexed annuities, they're doing two things here. They're usually protecting their assets from market volatility and earning safe interest through indexed growth with a 0% guaranteed floor. And then they're also generating lifetime income streams. Not always do you have a combination of the two. Some people elect to just go with the safe growth, where others will go with the safe growth plus add a lifetime income rider, so that in the event the growth does not occur due to market performance or lack thereof, they have that income rider that has been growing guaranteed in the contract that they can fall back on. So everybody's situation is different, just comes down to your personal preferences. Okay, so they talk about managing risks here with a guaranteed income plan. You obviously want to grow your assets, create an income stream for life, and then develop a plan that's conducive to change and that's flexible. And an indexed annuity is ideal for flexibility. On the growth side of the guaranteed income indexed annuity, you have a few different index crediting options to look at. You have the traditional S&P 500 index, and then they have the City Flexible Allocation 6 Excess Return Index. Now, that is a volatility controlled index where it is rebalancing and repositioning assets based on levels of volatility. And if I was to pick of the two, and we'll dive into them a little bit more in depth in terms of what growth can be anticipated potentially if markets perform, I would personally pick the City Flexible Allocation 6, and I'll show you why here momentarily when we dive into these indexes to see how they're performing, along with the associated participation rates that are offered in the contract. They also offer a fixed account inside the guaranteed income indexed annuity. We'll look at that as well. But really, it comes down to understanding how to create a guaranteed income stream for life. So when you look at the entire landscape of retirement, you see, where we're currently at, where most people retiring today do not have a pension. Only 13% of the private sector workforce has a pension. So if you find yourself with, to be one of those people or the other 87% that does not have a pension, the importance of a pension or a guaranteed lifetime income stream that, you'll never outlive, and it's not dictated or determined by market performance, it adds a level of peace of mind that, you really just can't put a price on. If you look at the studies, going back, a few generations to where pensions were more prevalent, the average retiree not only, had income that was going to last the rest of their life and cover their essential living needs in retirement and the costs that are associated, but they also did some surveys where they found that people were happier 10 or 2-3 generations ago. And it is determined that, obviously different scenarios have been happening throughout the last 20 or 30 years. But more importantly, having that peace of mind that no matter what happens to the economy, no matter what decisions are made from a political perspective or standpoint, no matter what happens from, just in general, a global perspective, that you have a peace of mind because of the guaranteed income that will be there every single month or every single year for as long as you live. So if that's important to you, or you're interested in having that be a part of your overall retirement plan to supplement Social Security, this is definitely an indexed annuity that you want to take a look at. So when you're looking at an indexed annuity that has a lifetime income component as well as the growth or accumulation component, I always advise our prospective clients to picture a T chart. So draw a T on a piece of paper. On the right-hand side of that T, you're going to have your what's called income benefit base, and that's a separate value. And then you'll have what's called your accumulation value. They're two separate figures, both moving in different ways in terms of how they're growing. On the guaranteed income benefit base side, when you buy an indexed annuity and add a lifetime income rider, in this case, you would be buying a lifetime income rider on this annuity. In the rider, it adds a level of guarantees on the growth component to your income benefit base. So what that means in this particular case, every year that you defer the income stream, so if you bought this at age 60, deferred it to age 65, you've deferred this annuity for 5 years. Every single year that you've deferred, the benefit base for the income, the guaranteed income amount, will roll up or grow by 4% interest every single year. Now, that is not a value that you could ever withdraw as a lump sum. The income benefit base is solely used to determine the lifetime income amount based on the age you turn it on, how long it's been deferred, and the growth that's been accrued over that deferral period. So there's really 3 main factors, and we'll look at those in more detail when it comes to figuring out how much your income will be. The main factor is how much has the income benefit base grown to, and what is the payout rate or distribution rate that is being factored in to determine the lifetime income amount. It's very simple. It's not any more complex than that. How much money is on the income benefit base account, and what's the payout rate based on your age? That's it. And a lot of these annuities with lifetime income, they'll offer an increasing payout rate every year. So the older you get, the higher that payout rate may be. So when you turn it on, if you were to turn it on at age 62 versus 65, at age 65, you would have a higher payout rate than you would at 62. So that higher payout rate would then be factored against the multiplied against the benefit base value. And that number is what you would determine your income stream to be. The payout factor rate multiplied by the benefit value, that equals your income amount. This is showing the benefit base here and growing, and you'll see it's on a axis here. You have the value on the y-axis, and then along the x-axis here, you have the years or contract anniversaries that you're deferring it. So your benefit base is guaranteed to grow each year in this guaranteed income indexed annuity by 4% simple interest roll-up. Now, if you wait after 5 years to turn on the income, they'll credit your benefit base a 15% bonus after 5 years. So this is ideal if you find yourself, 5 to 10 years before retirement and you're looking to create a lifetime income stream for retirement income. This is a great product to take a look at, because if you can defer it at least 5 years, they're going to give you a 15% bonus added to that benefit base value that will be factored in to determine your income. After 10 years, a 20% bonus is credited to your benefit base. So if you wait to 10 years, you'd actually get another bonus of 20%. So very big opportunity if you're looking to defer income and you can afford to do so, and that works out in your overall plan. It's definitely something to take a look at. Now, the other benefit is this type of annuity, or this specific annuity, the guaranteed income indexed annuity by Protective Life. The benefit base, if you choose the rising income option, your benefit base that's used to factor in your income has the ability to what we call enhance or increase the income potential based on how the index is performing in the annuity. So when we look at an indexed annuity, you have your principal or your initial investment, and that sits over in your accumulation value. And then your accumulation value gets credited interest based on how the index and the index crediting option that you're assigned to performs. In this annuity, it also adds, if you choose the rising income option, which you can choose two different options, fixed income or rising income. If you choose the fixed income, whatever that income amount is, and you activate it, that's what it stays at for the remainder of your lifetime. If you choose the rising income, the income has the ability to increase over time based on how the index performs. So when the index gets a interest credit or accrues an interest credit, that also gets applied to your benefit base, and it increases your overall lifetime income value moving forward. Now, there's no free lunch here. We're obviously going to discuss the rising income. Is it better than the fixed income? There, in my experience, in my professional opinion, it can be better, but it's going to obviously be based on market performance. And then there's a what we call a break-even point. Traditionally, in most cases, that in an annuity that offers income that's increasing based on index performance, we usually see that break-even point around the 12th or 13th year of the contract. What I mean by that, if you were to start with the fixed income amount first versus the rising income would not reach the level of the fixed income until about 12, 13 years typically. And it's all obviously based on market performance, but because of the rising income initially starting at a much lower amount versus the fixed income, which starts at a higher amount, it takes quite a while for that rising income to surpass what the fixed income was. So then it just becomes a longevity play. If you're going to live, anticipate living a longer life, or you just like the idea of an increasing paycheck based on market index performance, rising income is something to consider. We actually usually will take a look at the fixed income most of the time, just because when it comes to increasing income, your overall portfolio should be able to provide increasing income from your returns. But if you're not wanting to play in the market at all, the indexed annuity with rising income may be something that you might want to take a look at. But here's what they're showing is another example where they're showing the benefit base, so just the dotted line. If you can't see this, enlarge your screen here on the video. But it's showing the dotted line, and it's getting a step up based on the contract value growing by 8%, which exceeded the 4% benefit base roll-up, which means they'll automatically increase the benefit base to match the contract value. So you get a step up based on index performance there and growth based on that contract value getting an increase. So we talked about the level income option. It guarantees a specific annual income payment for life. This option starts out with a higher income amount than the rising income option, but since your income does not change over time, it provides lower income amounts later in life than the rising income option would. So that's a good point to make. Like I said, if you anticipate living a longer life, which people are living longer than ever before, the rising income ends up outperforming on a longer term basis. It can be great for keeping up with inflation, as well as maybe paying for the cost of healthcare down the road, maybe for long-term care or cost of care, confined care, things of that nature. They're showing in the green at the bottom here, just showing those level payments, but that the rising income has the ability to continue growing over time. The rising income option guarantees your annual income payments will rise each year until your contract value reaches 0 or until you reach age 95, whichever occurs first. This option starts with a lower income amount than the level option, but since your income payments will rise each year, this option provides higher income amounts later in life than the level income option. So again, really looking at this, you have to consider longevity into the equation. And if you're going to have enough time to allow for that income to increase to surpass the fixed income option. We'll be diving in momentarily. If you stick with us, we'll pull up our software and be able to show you the difference in the fixed income versus rising income starting day one, and then seeing what it could end up growing to as it increases compared to the fixed. Now, when it comes to calculating the withdrawal amounts, like I said, the first factor is the benefit value. How much is it? And then based on your age, most of these indexed annuities have what's called an annual increasing payout rate or distribution rate. All it is how much of, what's the payout rate? You apply that, or multiply that rather, to the benefit value, and then that equals your income amount. So here they're showing a scale, and you can look at the differences. We'll look at single life just to make things easier for both of these, but they're showing the payout rates for the level income and the rising income. Let's look at a 60-year-old male, single life on the level income options, 4.95% payout rate. So if your benefit base was $100,000, you'd multiply 4.95% by $100,000, and that would equal your income amount on an annual basis for life. And if you look on the other side, the rising income, you'll see it starts at 3.95%. So a 1% difference right there, that kind of gives us the idea of, what's the difference in rising versus level. In this case, it's a 1% difference on the income payout rate. Now, in the brochure here, we won't spend too much time, but they're showing an example of a lady named Kathy, female, age 60, retirement age is 70. She's buying this annuity for $100,000. And at age 70, Kathy is ready to turn on the income. So they'll look at the income benefit base. In this example, it was $180,000. And because at age 70, the payout rate is 6%, 6% multiplied by 180,000, her payout rate moving forward for the rest of her life will be $10,800 on an annual basis. And then on rising income, we have Sam, male, age 60, retirement age at 65, also putting $100,000 in this income annuity. And the difference is that he's going to be turning his income on at 65, so he's turning it on 5 years earlier, and it was also on the rising income option. So let's take a look. His income benefit base at age 70, I guess they're going to compare the same age. So at age 70, Sam is ready to start taking income from his annuity. He chooses the rising income option on a single life basis, and with the rising income option, Sam's initial annual payment will be $7,110. Then each year, Sam's withdrawal percentage will increase. So what they're doing here is they're showing the benefit of the annual payment growing by the payout rate. So the payout rate scale increases every single year. If you look, it starts at 59, you're looking at 39 or 3.95, excuse me. But at age 70, he's turning on the income stream. So that none of these numbers, ignore those up top. But at age 70, it's a 4.95% payout rate. His income would be $8,910. So you'll see every single year from then on, it's increasing based on the payout rate increasing. So I think I may have misstated the way this indexed annuity works from the rising income. I confused it with one of the others on the market. This one actually increases based on the payout rate increasing because of the age increase every single year. So like I said, most of these annuities, every single year that you age, the withdrawal percentage, or what's known as a payout rate, increases. And in this case, on this annuity, it's increasing by 10 basis points. So you'll see at age 70, the payout rate or withdrawal percentage is 4.95%. That's equaling an $8,910 increasing income option starting in year 70. But because the withdrawal percentage increases on an annual basis, you'll see the income continues to go up. So very cool stuff there. With the choice of the increasing income option, Sam can expect to receive an annual payment of $10,800 for life at age 80, even if his contract value has reached zero. So in an indexed annuity, what they're referring to when they say the contract value reaches zero, when you start to take your income stream in an indexed annuity with a lifetime income rider, the income stream that you take on an annual basis is deducted from your accumulation value, or also referred to as a contract value. So if you have $100,000 in the accumulation value and you're taking $10,000 out a year, you'll see the accumulation value dwindling by $10,000 or decreasing by $10,000 each year that income is taken. Now, keep in mind, your accumulation value still has the opportunity to grow based on the index performance that's inside the annuity. So if you have 5% growth from the index 1 year, you'd get 5% interest credited to your accumulation value. So that also factors in. And so you're not going to always just, completely deplete it by taking 10,000 out, and in 10 years, if it was 100,000, it'd be empty. You're also going to have interest that's coming into that account as well. So it is going to take a while for that account to deplete. But in the event that it does deplete to zero, okay, and that would often be because of index performance being minimal, or you've lived a very long life and taken income for so long. But either of those two factors, if that happens, the beauty of these indexed annuities with lifetime income guarantees is that even if that occurs, you're going to be paid the same amount from the lifetime income forever, as long as you live. So other benefits you should consider in this annuity, you have access to your money. So in the event that an event arises and life happens, or certain scenarios that may require you to access your money, the following information here will tell us how much we can withdraw on an annual basis penalty-free. So in this case, on this annuity, it's 10% of your initial purchase payment during the first contract year, with no withdrawal charge or market value adjustments applied. After the first year, you can withdraw 10% of the contract value as of the prior contract anniversary annually, less any withdrawals in that contract year. So all that's saying is whatever your contract value or accumulation value is at the beginning of that contract year, you can access up to 10% of that value with no penalty from surrender charges or market value adjustments applied. So if you're new to indexed annuities, these are what we call a time deposit investment. In order for the insurance company to offer us as a consumer the principal protection and guarantees that we can't lose money to market volatility, we have to keep our money in there for a certain period of time. In this case, it's a 10-year surrender period. It doesn't mean you can't exit. If you exit early, there's just going to be a penalty. You'll see here is the 10-year surrender charge schedule. The fees are 9% the first 2 years, and then they decrease by 1% per year, ending at 1% year 10. So very important to make sure when you're planning for retirement and you're looking at this annuity, that you have enough liquidity outside of this annuity and the rest of your overall retirement plan to take care of those unexpected spending shocks that may occur down the road. However, in the event, God forbid, you do need these funds, you have the ability to withdraw up to 10%. And if you need more than that, you can access more, just going to pay a penalty on those funds above and beyond 10%. In addition, we do offer in this annuity the nursing facility or terminal illness waiver rider. What that means is if you're confined to a qualified medical care facility for at least 30 consecutive days or diagnosed with a terminal illness expected to result in death within 12 months, you or your spouse can access all of the funds inside the accumulation value account without incurring any surrender charge or market value adjustment fees. In addition, they offer, which is pretty unique in this one, they offer an unemployment rider at no charge. It allows you to access your money to help with the financial burdens of unemployment. They'll waive the withdrawal charge and market value adjustment if you or your spouse should become unemployed. In order to qualify, you and your spouse must meet the following requirements, and that is that you were employed full-time at the date of issue of the contract for the annuity, and that you've been unemployed for at least 60 consecutive calendar days to claiming the waiver, and that you've unemployed on the date when the full surrender or partial withdrawal is requested. This waiver may not be available in all states, so please check with your financial professional or check with us at annuityassociation.com. Okay, so quick facts. The availability for this annuity, the ages are 50 to 79. Minimum initial investment is $25,000. Max is $1 million. In addition to that, when it comes to annual fees, it's one of the stigmas that comes along with the annuity world. Unfortunately, variable annuities have just burdened the rest of the annuity industry with the stereotype of highly feed. In indexed annuities, it's possible to have zero fees, and the only time a fee is applied is in the event a rider is added, or a feature. A rider is another word for a feature or option. If that's added, in this case, this annuity would come with the lifetime income rider. They do charge a 1.2% rider charge applied to the benefit base amount on an annual basis. Okay, so that's pretty much it. Now let's go ahead and dive into our software, and we're going to take a look at an example of what the lifetime income would be for a male age 60 in the state of Florida. Actually, let's do female this time. Change it up. So female, age 60, in the state of Florida, she's going to invest initially $100,000 in this annuity. And we want to see how does it compare to the rest of the annuities on the marketplace. So what we have here is our software designed to show us all of the independent products on the marketplace to see how they compare and list them in chronological order from highest to lowest on a guaranteed income from a guaranteed income perspective. So you'll see Protective comes in at number 1. Now take a look here. We're basically building this tool to show us income starting immediately. So this person's buying this annuity and activating income within 1 year of buying this annuity. And in that case, if they're not deferring it at all, they're turning income on immediately. You'll see Protective Guaranteed Income Indexed Annuity comes in at number 1. And in this case, you'll see that 4.95% payout rate factored, multiplied by that $100,000 benefit base, and that's generating a $4,950 guaranteed annual income for life. On the right here, you see the 4% roll-up rate. That's that guaranteed growth rate that is applied to the benefit base if you defer it, and it will grow at 4% each year for up to 15 years if you deferred it that long. And then you see the 1.2% fee charge for the rider. And the 2% max, what that means is contractually they could never charge more than 2%. So that's just some peace of mind there. Okay, now what we're going to do is envision or just kind of come up with a hypothetical scenario that this 60-year-old woman in Florida putting $100,000, let's say she's not going to retire until, or at least take income from this annuity for 7 years. So she'd be turning on income age 67 or contract year 8. Now, you'll notice that the top options changed. Protective Life is not there. It's actually a different company. National Western Life is coming up number 1 for this particular scenario, and it's listing the guaranteed annual income from the highest amount to the lowest amount chronologically. You'll see that Protective Income product, though, does come in 3rd overall. And you'll see the benefit base has grown to $156,000. And actually, this is a different product. Let's keep looking. That's actually their other income product. We want to find the guaranteed income. You'll notice it's right here. Protective Guaranteed Income, $8,080. The benefit base has grown to $143,000, and it has a 5.65% withdrawal percentage or payout rate because of the person being age 67 when they turn it on. So it kind of gives you the idea of the logistics of how the annuity works. The longer you defer it, the higher the benefit base grows because of the guaranteed 4% growth and the higher income withdrawal percentage of 5.65% that's based on them aging each year. Remember, it increases by 10 basis points. Now, we've just basically showcased our abilities here to help you as a prospective client determine which annuity is going to be ideal for your situation based on deferring it shorter term or longer term. Obviously, Protective is competitive, but not always number 1 as we see here. But let's go ahead and just read out the rest of the company since this is a review on Protective Life, Guaranteed Income Indexed Annuity. And let's filter those out and just look at Protective. Now, let me see if I can get this just the one product we're looking at. Okay. Let's see. Bear with me. Okay, what we're doing is trying to filter these out just to look at Protective. They have a couple different income products. Some are better than others, depending on when you defer it and how old you are at the time of activating the income. So we want Protective level. Okay. All right, so we're going to look at just turning on income immediately rather. You'll notice that the Guaranteed Income Indexed Annuity is the best option. Let's see how it performs deferring it on an annual basis. So you'll see year 1, deferring it 1 year, the income benefit base has grown to $104,000 and a 5.05% withdrawal percentage. Guaranteed income for this case is $5,252. And you'll see that each year that we scroll, the value goes up. Now, you'll notice when I defer to 3 years, their other income product called the Protective Income Builder comes in as the better option. But you'll notice that the Guaranteed Income Indexed Annuity comes in second. In this case, once you get to income for deferred for 3 years. And from that point on, year 5, it actually does come back into the picture. So what's happening here is, remember, if you deferred for 5 years, the Guaranteed Income Indexed Annuity gives a 15% bonus on the benefit base. In addition, we're having a higher distribution or withdrawal percentage because the person is aging to, in this case, 65. They're at age 65. Let's see what happens when we go another year. So again, Protective, their other product, the Income Builder, comes in, and so on and so forth. Now let's take a look at the rising income option. So we'll go ahead and filter all of these out and look at the rising income or increasing income option. Might have to do that one a different day. It's not showing the Guaranteed Income Indexed Annuity, only the Income Builder. I wonder what happened there. Let's see. Let me take out this filter. Let's go back to Protective. While we're looking for this, if you are in the process of buying an annuity or comparing an annuity to another, and you want to take a look at, which annuity is best for your individual circumstances, you can go to annuityassociation.com, and right on the main page there's a submission form that you fill out, and you can request a free report, and we will send out the top annuities based on your individual circumstances. Okay, it doesn't look like, here it is, rising income. Okay, so the rising income is starting 1% lower on the income withdrawal percentage. So when we increase it, let's go ahead and defer it 1 year. Okay, it's still down there, but let's go out 10 years. Let's go out 15 years and see what it looks like. See if it would be any different. Now, keep in mind, on the rising income, the way that works is each annual year, they're giving you a higher withdrawal percentage amount. So at year 15, just out of curiosity, I wanted to take a look. It's at 5.45%, $10,628. So if you were to buy this annuity and get the fixed income option and activate it at age 65, you would only be at $7,358 for the rest of your life. If you bought the rising income, let's see if I can get that to come up just by itself so we can look at it together. Okay, perfect. So rising income here would be $6,008 at age 65. And even if you activate it at age 65, it's going to continue increasing. So what we want to do, let's go back to level and see what the income amount is at age 65 on the fixed account, fixed the level of income option, so $7,358. Now what we want to determine is how long does it take the rising income to get to $7,358, even after turning it on at age 65. So you'll see we defer it year 6. We're not actually deferring it, but this is still showing us the growth. Actually, this isn't going to be apples to apples just because of the, it could be. It's showing still the roll-up rate being factored into that too, plus the increasing withdrawal percentage amount. But right now, even with that considered, we're deferring at 9 years, or we're out age 69. So we started at 65. So we're at 4 years there, and it's still not up to the 7,358. But then the following year, it doesn't surpass it. So about 5 years. But that's also kind of unfair because it's increasing the benefit base. So that wasn't really an apples to apples comparison. So please disregard that. You would not be getting the 4% roll-up guaranteed. Once you activate the income on the rising income option, your benefit base is locked at whatever that value was, and the only thing that increases is the withdrawal percentage. So disregard that. Let me see if I've got another way to do this. Hold on one second. No, it's not going to do it. All right, so let's go ahead. We've covered the benefits and features. We've covered the fees on the rider. We also talked about the waiver for confined care and terminal illness. And we also looked at what the income would look like and the withdrawal percentages based on your age and if you choose the income level income option or the rising income option. The last thing to take a look at here is to compare the growth side or the accumulation value side. In this annuity, they offer the S&P 500 as well as the Citi Flexible Allocation Index, which is a volatility controlled index. So let's take a look at the performance. Now, keep in mind, when we look at the protective guaranteed income indexed annuity, this is purely a lifetime income play. You're not looking at this for growth. You're looking at mind. Because of it being an indexed annuity, you do have an accumulation value that will experience some level of growth based on how the indexes perform. But because of the participation rates and the strategies behind that, the growth opportunity is not very high. So I must make you aware of that. However, if you're looking for lifetime income in an indexed annuity that gives you still control over your principal, versus a single premium immediate annuity, the protective life guaranteed income indexed annuity is very competitive in that regard, and one of the highest when it comes from a lifetime income perspective if you're activating it near term, immediate, within 5 years. Because of that bonus they give at the year 5, it makes it really competitive. And if you're activating income immediately and you like the income annuity with an index strategy because it gives you growth opportunity plus control of your money versus putting it all in a single premium immediate annuity. If you put all your money in an immediate annuity, you have no control over the money that you invested. So once you turn on income in an immediate annuity, your control to the funds in the annuity are gone. In an indexed annuity, you can start taking a lifetime income stream, but you still have that accumulation value sitting on the sidelines that's earning index growth as well as giving you liquidity in the event you need it, God forbid, for an unexpected event. But anyhow, the Citi Flexible Allocation 6 excess return point to point with a participation rate strategy, that is the best one. Looking back 10, 15, and 20 years in this particular annuity, we'll see the average annual growth was 2.01%. Best 10-year period was from 2001 to 2011, September. 5.42% over that 10-year period. And then the worst case scenario was 12/30 of 08 to 12/30 of 2018. This threw out a 1.75% average annual credited interest rate. So that's very important to see, what's the best and worst that you could potentially expect. Now, keep in mind, prior performance is not an indicator of future performance. It's all based on how the indexes perform and how the economy is moving forward. But because of the guarantees of 0%, 0% floor, 100% principal protection from market volatility, you do have a little bit of growth that you could experience on your accumulation value. And I would say if you could just keep the average annual credited interest that you experience, let's say it is 2%, if you could even keep that 2% consistent over the life of having the annuity, in theory, because you only have a 1.2% rider fee and you're taking a distribution, the monies are going to last quite a while in the account because of that. So one last thing here, and we will wrap it up. So what we like to do is look at the indexes to see how they're performing year to date. Let's take a look at that City Flexible real quick and take a look and see what's going on there. So you'll see it right here, the City Flexible allocation, year-to-date performance 6.88%. Now keep in mind the participation rate in this annuity is 55% on that index strategy. So of that, if you were in this annuity year-to-date and it was an annual point-to-point, which in that particular strategy that we just took a look at, it's a 2-year point-to-point, you would get, if it was an annual point-to-point, you would get credited if your contract anniversary date was ending today, 3.78% credited to your accumulation value. Okay, so year to date, the City Flexible is at 6.88%. And let's take a look real quick and we'll conclude this annuity review. But I want to take a look at the fixed account, all of the index options, including the fixed account too. Current rate's a 1.05% fixed rate. And then the S&P is offered in this annuity as an index option, but it's not very attractive because they have these caps set on them on the 1-year point-to-point. It's a 1.95, and that's for a term. And then on the other 1-year point-to-point, it's a 2.05% cap. So that just means even if the index performed at 10%, you're only going to get 2.05 credited to your account. It's not very attractive. If you're looking at growth and using the S&P 500, there are better annuity options out there in the indexed annuity world. But the City Flexible, you'll see 2-year point-to-point. Here is a 55% participation rate. So what that means is in the index went up 10% for that 2-year strategy. Okay, it's a 2-year point-to-point. Then your accumulation value would be credited 55% of that 10% growth, or in this case, 5.5%. So hope that makes sense to you. If you'd like to request a personalized illustration on the Protective Life Guaranteed Income Indexed Annuity, or you'd like to compare this annuity to one you already own or one that you're contemplating on buying or investing in, please go to feel free to go to annuityassociation.com, fill out the request for your free report, and we'll get that out to you in a timely fashion. And if you'd like to go over it in detail, we can also set up a time to discuss that and make sure that you're making an educated decision on the best annuity for your individual circumstances. So hope this review has added some value to your decision-making process. If you have any questions, you can leave a comment here on our YouTube or Facebook channel, or go to annuityassociation.com and you can ask a question there as well. So thanks so much for tuning in. Hope everybody has a happy new year coming up, and take care of one another. Thanks so much for your time. Bye-bye.